In this week's market update, all eyes are on the Fed in a busy week for central banks. The oil market is in focus as tensions rise in the Middle East. Hong Kong's future is in question as China attempts to tighten its grip on the former British territory, and the field narrows in the bid to be Britain's next Prime Minister. After 2 weeks away from the markets, I've returned to find very little has apparently changed. Stock markets around the world remain off but close to recent highs, despite growing fears about the sustainability of growth. Volatility is low and shares relatively buoyant, despite disappointing economic data and troubling messages from the bond market, where signs of economic slowdown continue to flash red. Some market watchers are concerned that investors are mispricing risk and are therefore vulnerable to a sudden reassessment, but others are hanging on in the absence of anywhere else to park their money and earn a decent return. It all feels a bit directionless, like a phony war as we enter the traditionally quieter summer months. This week's main focus will be on central banks and the Fed in particular, amid rising expectations that the US central bank is poised to cut interest rates as it has in the past to maintain flagging economic momentum. Precautionary rate cuts in the 1990s kept growth and the bull market going then, and optimists hope the Fed can perform the same trick this time round. Most economists expect the Fed to leave rates unchanged at the end of its two-day meeting ending on Wednesday. Concerns about the mounting impact of trade tensions, however, are pointing to as many as 3 quarter-point rate cuts this year, starting in July. This expectation of easier monetary policy is one of the key props for shares at the moment, so all eyes will be on any commentary around the latest decision and what it says about the new trajectory of US rates. In particular, investors will be looking for any repetition of Jerome Powell's comments about the Fed closely monitoring economic developments, and they will scrutinise the so-called dot plots diagram, a graphical illustration of the rate forecasts of individual rate setters on the policy committee. The most recent of these pointed to likely rate rises to come. The latest dot plots may well point the other way. The June meeting will also include updates of economic forecasts from the Fed, including the outlook on growth and inflation. Expectations for rate cuts have pushed bond yields lower, not just in the government bonds that typically benefit from lower interest rates, but also the so-called junk bonds, which tend to be more growth-focused. US high-yield bond funds took in $1.5 billion in the week ended 12th of June, putting an end to weeks of outflows as trade tensions had dampened risk appetite. Since then, expectations of lower interest rates have seen money chasing yields as the income from safe government bonds has fallen. Since the beginning of the year, the yield on US 10-year bonds has fallen from over 2.7% to just 2.1%. Also in the spotlight this week will be the Bank of Japan and the Bank of England, both of which are also setting interest rates this week. Both are also expected to leave rates unchanged, although the pressure on a rate hike is probably greatest here in the UK, where at least a couple of rate setters are thought to be veering towards voting for an increase. UK interest rates have remained anchored close to a 300-year low, in contrast to the US experience, where rates started rising a couple of years back. The situation here has obviously been driven by a high level of Brexit-related uncertainty. As the Conservative Party engages in its current search for a successor to Theresa May, that uncertainty remains as intense as ever. This week should be a decisive one for that leadership election, with a BBC debate between the 6 candidates still in the race and a couple of votes designed to whittle the number of contenders down to the 2 that will be put to the 160,000 or so members of the Conservative Party to decide between. Boris Johnson remains the front runner, standing on a Brexit at all costs platform. He has said that Britain will leave the EU come what may by October the 31st, although it remains unclear how he will actually achieve that in the absence of any flexibility from Europe on the terms of the divorce agreement or support from Parliament for a no-deal departure. As such, the chances of a general election later this year seem to be rising, despite the fact that neither main party relishes that prospect in the wake of a disastrous showing by both in the European elections in May. The market impact of Britain's political uncertainty continues to be felt most obviously in the currency market, where the pound stands at less than $1.26. That's pretty much as low as it's been since 2016's EU referendum, save for a couple of short-lived spikes lower. Any sign that we're indeed heading towards an economically damaging no-deal exit would likely push sterling lower still. The positive impact of a weak pound has been the relative resilience of the FTSE 100 index, which, as an internationally focused measure, tends to benefit from sterling weakness. Elsewhere in the world, tensions are rising, with potential and actual knock-on market impacts. In the Middle East, the standoff between the US and Iran has intensified since Donald Trump withdrew a year ago from a deal struck by former President Obama, which had rewarded Iran's curbing of its nuclear program with trade deals and investment. President Trump has instead swung the other way over the past 12 months, imposing economic sanctions on Iran in a bid to force regime change in the country. Tehran is under growing pressure, but it's fighting back, and this week it raised the ante by once again cranking up its nuclear plans and confirming that it's poised to breach limits on its uranium stockpiles as it increases atomic activity. Within the last week, the US has also blamed Iran for attacks on shipping in the Gulf, which Iran denies. The market impact of all this is hard to measure because rising tensions, which would naturally push the price of oil higher, have come alongside other developments such as the expansion of US shale oil production and slowing economic growth, which tend to push oil lower. For now, supplies remain plentiful and the oil price has fallen back from a high last autumn of $86 a barrel to less than $62. Clearly, any move towards military intervention in the Gulf region has the potential to reverse that price move pretty quickly, but the consensus is currently that oil has found a new trading range, one that won't suit many producers, but which they may have to live with, especially if Iran's resolve falters. The second area of political tension with a potential market impact is in Hong Kong, where some of the biggest ever anti-China protests have been triggered by a proposed change in the law in the former British territory that would allow extradition of criminal suspects to China. Hundreds of thousands of protesters filled the city streets over the weekend, calling for the shelving of the controversial extradition bill. And on Monday, the call shifted to a demand that Hong Kong's chief executive, Carrie Lam, should resign over her handling of the affair. Now, the significance for financial markets is that Hong Kong has enjoyed a unique position within China since the handover of the territory by the British in 1997. Under the so-called one country, two systems formula, by which Hong Kong was guaranteed some autonomy, the city has become Asia's most important financial hub. It sits on the edge of China's most dynamic economic region, but it also benefits from an independent judiciary, press freedoms and rule of law. When that system was set up for 50 years from 1997, its end date of 2047 must have seemed far away. But as the years have rolled on, the reality has dawned that Hong Kong will at some point become just another Chinese city, subject to Beijing's whims and a much less attractive place for Western investors and businesses. And finally, investors are starting to look forward to next week's G20 summit in Osaka in Japan. Trade tensions will be top of the agenda, with hopes that Presidents Trump and Xi will be able to unblock talks and move towards some kind of accommodation. The threat of trade tariffs and a reversal of globalization remain the biggest threats to markets.